Good morning, class 12. The name of the chapter is Accounting Ratio. It should belong with your accountancy chapter. Business firms adopt several measures and techniques to assess and analyze the business venture, professionally, and profitability. The report thus availed business owners tend to make necessary adjustments to boost their income and to property a favorable financial image. Also, prospective business partners and investor base their decision of investing in the venture of a company entirely on its financial standing. Naturally, both business owner and potential investor use financial tools like accounting ratio to gauge the proficiency of business firm both in terms of earning profit and meeting liabilities. Now, what is accounting ratio? Typically, a ratio can be described as a mathematical expression that indicates the relationship between various items. Similarly, when ratios are computed with the help of financial data recorded in a company's financial statement, they are known as accounting ratios. Notably, there is a more than one type of such ratios, but we will check them out once we become familiar with the fundamental aspect of accounting ratio in general. See the types of accounting ratio. There are four types of ratio in accounting. Find more about them below. Number one, liquidity ratio. This particular accounting ratio helps to measure a firm's liquidity or their ability to repay its short term financial liability at any given point of time. Liquidity ratio is further divided into two types, namely the working capital ratio or current ratio. It indicates relationship between all current assets or all income and current account receivable and current liability or short term debt and account payable of a firm. The said ratio is expressed as below. Okay. Current assets minus current liability. The next formula, acid test ratio, or you may say quick ratio or liquid ratio. This ratio expresses a relationship between the quick assets and quick liabilities. Now, see what is quick ratio. Quick assets divided by current liability. Quick assets means marketable security plus accountable receivable plus cash and cash equivalent. And current liability, as you know very well, creditor, bills payable, outstanding, all these are current liabilities. But bank OD is not recommended in acid test ratio as a current liability. Now see solvency ratio. The said ratio helps to determine the solvency or the ability of a business to pay its shareholder for long-term contractual obligations. Solvency ratio is a four type. Number one, debt equity ratio. It is the most potent ratio in the accounting as it shows the relation between the firm's long-term debt and its share of the equity. The ratio is expressed with the help of this formula. Debt equity ratio equal to long-term debt divided by shareholder fund. Total assets to total debt ratio. Number 2, total assets to total debt ratio. It helps one to measure firm's efficiency in covering its share of long-term debt. It is expressed as total assets to total debt ratio equal to total assets to total debt ratio equal to total assets divided by long-term debt. As here again second formula, insolvency ratio is total assets to total debt ratio. It helps one to measure firm's efficiency in covering share long-term debt. It's expressed as the formula is total assets divided by long-term debt. Next formula is interest coverage ratio. This accounting ratio helps to measure a relationship between the bulk of profit that is available to a firm for interest payment and the value of long-term debt. It is expressed as interest coverage ratio equal to net profit divided by long-term debt. Proprietary ratio. It signifies the relationship between shareholders' fund to the capital employed or total assets. Typically, it is expressed as proprietary ratio equal to proprietor's fund divided by capital employed or total assets. Next formula is profitability ratio. The particular set of ratio helps to measure the profit and efficiency of the firm. There are 5 types of profitability ratio. Number 1, operating ratio. Operating ratio equal to cost of earning generated through operation plus operating cost divided by net earning from operation into 100. Operating profit ratio. Operating profit ratio equal to revenue from operation minus cost of operation divided by revenue from operation into 100. Next, gross profit ratio. The formula of gross profit ratio is gross profit divided by net earning from operation into 100. Net profit ratio. Net profit ratio equal to net profit divided by revenue from operation into 100. Number 5, return on investment or capital employed. Return on investment or capital employed equal to gains before tax and interest divided by capital employed into 100. Turnover ratio or efficiency ratio. This ratio in accounting tends to signify the frequency at which a firm performs its operation by employing its assets. Notably, a higher turnover ratio indicates effective utilization of assets and in turn hint at professionalism. Is further divided into 4 types. Number 1, inventory ratio. Number 2, trade payable turnover ratio. Inventory ratio equal to cost of revenue divided by average inventory. Our trade payable ratio, that is net credit purchase divided by average trade payable. Now turnover ratio or efficiency ratio. This ratio in accounting tends to signify the frequency at which a firm performs its operation by employing its assets. Notably, a higher turnover ratio indicate effective utilization of assets and in turn hint at a professionally. The question, it's a balance sheet. This type question may come in your examination. This is the balance sheet: liability, share capital, profit and loss account, general reserve, debentures, sundry creditor, bills payable, land building, plant machinery, stock, sundry debtor, bill receivable, cash at bank. Find out the current ratio, quick ratio, inventory to working capital, debt to equity ratio, proprietary ratio, capital gearing ratio, current assets to fixed assets. In a current ratio, divided by current assets divided by current liability. Current assets equal to